Imagine waking up to news that the stock market has dropped by 20% overnight. Panic is setting in, and the financial world is scrambling to make sense of it. Your retirement savings, your investments, your wealth, everything suddenly seems at risk. While market crashes may feel like random bolts of lightning, history tells a different story. In fact, some of the most devastating stock market crashes share a striking pattern. They happen around the same time of year again and again, but why? What makes certain times of the year more dangerous for your portfolio? And more importantly, are we on the verge of another financial disaster? Let's dive deep into the history of market crashes, explore why certain months, especially October, are so notorious for financial calamity, and see whether today's market might be heading for another historic collapse. Throughout history, October has earned a chilling reputation in financial circles. This month, often associated with Halloween, has also come to symbolize fear and dread in the world of finance. From the crash of 1929 that triggered the Great Depression to the infamous Black Monday in 1987, October has often been the harbinger of doom for the stock market. But October's dark reputation isn't the only seasonal trend that investors should be wary of. Let's start by breaking down the most infamous market crashes in history and their commonalities. The stock market crash of 1929, the beginning of the Great Depression. The 1929 crash, also known as Black Thursday, Black Monday, and Black Tuesday, is arguably the most famous stock market crash in history. It began on October 24, 1929, with a massive sell-off that wiped out fortunes overnight. The causes were multifaceted: rampant speculation, excessive debt, and a speculative bubble in the market. People were borrowing money to invest in stocks, creating an unsustainable financial bubble. The crash set off a series of bank failures, massive unemployment, and a global depression. By 1932, the US stock market had lost nearly 90% of its value from the 1929 peak. Key takeaway. The crash of 1929 kicked off in late October, and its devastating effects lingered for years. This was the first instance that began the association of October with market collapses. Fast forward to October 19, 1987, a day that would go down in history as Black Monday. The Dow Jones Industrial Average plunged by a staggering 22.6% in a single day. The causes were complex, a combination of computer-driven trading, illiquidity in the market, and macroeconomic concerns about inflation and rising interest rates. Black Monday was notable not just for the sheer scale of the drop, but for how fast it happened. Unlike the slow-burning collapse of 1929, this crash seemed to come out of nowhere. Investors lost billions in hours. It was a reminder of how fragile the stock market could be, even in the modern era. Key takeaway. Once again, October proved to be the market's Achilles heel. Even in the age of modern technology and more sophisticated financial systems, October remained a month of high volatility and risk. The 2008 financial crisis. While October 2008 didn't see a single-day market drop as dramatic as 1987, it was one of the most volatile months in financial history. The 2008 financial crisis, triggered by the collapse of the housing bubble and massive exposure to toxic mortgage-backed securities, resulted in multiple days of sharp declines. The S&P 500 lost over 30% of its value in a span of weeks, as banks teetered on the brink of collapse and global markets spiraled into chaos. Lehman Brothers filed for bankruptcy in September 2008, and by October the markets were in full panic mode. Once again, October lived up to its reputation as a month when financial markets could unravel with shocking speed. Key takeaway. Even during modern financial crises, October remains the month when market volatility reaches its peak. Part 2. Why do crashes happen in certain months? The October effect and beyond. With so many historic market crashes concentrated around October, it begs the question, Is there something about this time of year that inherently makes it more likely for financial disaster to strike? The answer lies in a combination of psychological, economic, and structural factors that align at certain times of the year, particularly in the fall. Investor psychology, the October effect. The October effect is a term used to describe the perception that markets are more likely to decline in October than in other months. While it's more of a psychological phenomenon than a proven financial principle, the fact that several of the worst crashes in history occurred in October reinforces this belief. It creates a kind of self-fulfilling prophecy. When investors expect volatility in October, they may act more cautiously, leading to larger sell-offs when bad news emerges. In short, the October effect is driven by fear. Investors, haunted by the ghosts of crashes past, tend to be more jittery during this month. A small decline can snowball into panic as traders rush to protect themselves from further losses. Seasonal market trends, September and October volatility. Historically, September has been the worst performing month for the stock market, with more consistent declines compared to any other month. This could be due to several factors, including the end of summer vacations, the re-evaluation of portfolios, and mutual fund redemptions as investors look to lock in profits for the year. By the time October rolls around, markets may be primed for greater volatility. If markets are already in a fragile state, a sudden piece of bad news in October can act as the trigger for a more severe correction or crash. Earnings season and economic data. The fall months, particularly October, coincide with corporate earnings season and key economic data releases. If earnings reports are disappointing or if economic data, such as employment numbers or GDP growth, miss expectations, it can trigger a reassessment of market valuations. In October, investors are often looking ahead to the next year's growth prospects. If economic indicators suggest trouble on the horizon, traders may start pulling out of the market, leading to a broader sell-off. Interest rate changes and monetary policy. Another reason fall, and particularly the third and fourth quarters, is volatile, is that it often coincides with significant monetary policy decisions. The Federal Reserve and other central banks typically assess economic conditions toward the end of the year and may adjust interest rates accordingly. A surprise rate hike or a signal of tightening monetary policy can spook markets, especially if investors have become accustomed to loose monetary conditions. This factor was particularly relevant during the 1987 crash and the 2008 financial crisis, where concerns over inflation and rising rates played significant roles. The current market. Are we headed for another October surprise? So with history as our guide, where do we stand today? Are we on the cusp of another October crash? While it's impossible to predict the exact timing of a market crash, there are several warning signs in the current financial landscape that suggest increased volatility in the months ahead. High valuations in a fragile market. In 2023 to 2024, many analysts and investors have noted that the stock market, particularly in the United States, is trading at extremely high valuations. This is especially true for sectors like technology and artificial intelligence, where stocks have seen meteoric rises despite questionable profitability. These high valuations resemble the overexuberance of the dot-com bubble in the late 1990s. If corporate earnings or economic data miss expectations in the fall, it could trigger a correction, especially in overvalued sectors. Rising interest rates and tightening monetary policy. The Federal Reserve has been aggressively raising interest rates to combat inflation. Higher interest rates make borrowing more expensive, which could hurt corporate profits and slow down economic growth. Historically, sudden or sustained rate hikes have been a major contributor to market volatility. If the Fed signals that rates will remain higher for longer, or if inflation remains stubbornly high, it could increase the risk of a market downturn, possibly in the fall months when markets are already more prone to volatility. Geopolitical uncertainty. Ongoing geopolitical tensions, such as conflicts in Eastern Europe, supply chain disruptions, and rising oil prices, continue to weigh heavily on global markets. Any escalation in these tensions could trigger a flight to safety, leading investors to pull money out of risky assets like stocks, causing a broader market sell-off. Fragility in the banking sector. As seen in early 2023 with the collapse of Silicon Valley Bank and Signature Bank, the banking sector remains vulnerable. Rising interest rates have exposed weaknesses in some institutions, and if more banks face liquidity problems, it could trigger a broader financial crisis, similar to what occurred in 2008. The question is whether these issues will come to a head in the historically volatile months of September and October. Part 4. Lessons from history. Can we prepare for the next crash? History doesn't always repeat itself, but it often rhymes. While we can't predict exactly when or how the next market crash will happen, we can certainly learn from the past to recognize the warning signs and prepare ourselves accordingly. By understanding the patterns, behaviors, and triggers of past financial disasters, investors can take proactive steps to protect their portfolios. One of the common threads in major crashes, from the 1929 stock market crash to the dot-com bubble, is that they were all preceded by periods of significant overvaluation. Stocks became detached from their underlying fundamentals, driven by excessive speculation, euphoria, or both. Today, certain sectors, particularly technology and AI stocks, appear to be following a similar trajectory. As valuations rise far beyond what company earnings and revenues justify, the risk of a market correction increases. Smart investors will monitor these valuations closely and may consider reallocating their portfolios towards safer, more stable assets if the market shows signs of overheating. Interest rates play a huge role in stock market performance, as seen during the 1987 crash and the 2008 financial crisis. When interest rates rise, it becomes more expensive for companies to borrow money, which can hurt corporate profits. Rising rates also make bonds and other fixed income investments more attractive, pulling money out of the stock market. With the Federal Reserve and other central banks signaling more aggressive rate hikes in 2023 to 2024, investors need to be aware of how interest rate changes might impact their investments, especially in sectors that are sensitive to borrowing costs, like technology, real estate, and financials. Geopolitical uncertainty has the potential to trigger market crashes, as it did in 1973 during the oil crisis, and more recently with the COVID-19 pandemic. With rising global tensions, especially in Eastern Europe, escalating trade wars, and ongoing supply chain disruptions, the global economy remains fragile. Any sudden escalation of conflict or a major geopolitical event could spark panic in the markets. Investors should diversify their portfolios globally to minimize exposure to specific geopolitical risks and hedge against unexpected events that could disrupt the markets. One of the key lessons from both the 2008 financial crisis and the panic of 1907 is that the health of the banking sector is closely tied to the overall stability of the financial system. When banks fail, panic spreads quickly. The collapse of Lehman Brothers in 2008 is a prime example of how a single institution's failure can trigger a global financial meltdown. In early 2023, the failures of Silicon Valley Bank and Signature Bank served as stark reminders that the banking system remains vulnerable. Investors should pay close attention to the health of the financial institutions in which they invest and watch for signs of trouble in the broader banking sector, such as liquidity issues or sudden drops in stock prices. While it's impossible to time the market perfectly, there are several strategies investors can use to protect themselves during times of heightened volatility and increased crash risk. Diversify your portfolio. You know, diversification is one of the best ways to mitigate risk during a market downturn. By spreading investments across different asset classes like stocks, bonds, commodities, and real estate, as well as geographic regions, you can reduce the impact that any one failing sector or market might have on your overall portfolio. And during times of uncertainty, shifting a portion of your portfolio into safer assets, such as government bonds, gold, or defensive stocks like utilities and consumer staples, can really help cushion the blow of a market crash. 2. Keep cash reserves. Warren Buffett's massive cash reserves are no accident. Having cash on hand allows investors to take advantage of opportunities during a market downturn. When stocks fall, many high-quality companies become undervalued. With cash available, you can buy these companies at a discount, positioning yourself for future gains when the market recovers. Buffett's strategy of accumulating cash during times of uncertainty is a powerful lesson for investors. While it's important to stay invested, keeping a portion of your portfolio in liquid assets ensures that you're ready to take advantage of buying opportunities during market corrections. 3. Don't panic. Stay the course. One of the worst things an investor can do during a market crash is panic. History shows that panic selling at the bottom of a crash locks in losses and prevents investors from participating in the market's eventual recovery. For example, after the 2008 financial crisis, markets rebounded dramatically, and those who stayed invested reaped significant rewards. Staying the course during periods of volatility can be difficult, but it's often the best strategy for long-term investors. By focusing on the fundamentals and resisting the urge to sell in a panic, investors can avoid making emotional decisions that could harm their financial futures. 4. Use stop-loss orders. For more risk-averse investors, using stop-loss orders can be an effective way to limit potential losses. A stop-loss order automatically sells a stock once it drops below a predetermined price, helping investors lock in gains or minimize losses in a falling market. While this strategy may prevent investors from benefiting from a rebound, it can provide peace of mind during periods of extreme volatility. Conclusion. Are we on the verge of another crash? Market crashes are a natural part of the economic cycle, and while we can't predict exactly when the next crash will occur, the signs of potential volatility are evident. October, with its dark history, remains a month of particular concern for investors. High valuations, rising interest rates, geopolitical uncertainty, and fragility in the banking sector all point to heightened risk in the months and years ahead. As we've seen in past crashes, the key to surviving and even thriving during a market downturn is preparation. By diversifying your portfolio, keeping cash reserves, staying calm in the face of panic, and utilizing strategies like stop-loss orders, investors can weather the storm and position themselves for success when the market recovers. While it's easy to be lulled into complacency during a bull market, history reminds us that markets can turn quickly and violently. The time to prepare is now. Whether the next crash happens in October or some other month, those who are ready will emerge stronger. Will the next October bring another Black Monday or Black Thursday? Only time will tell, but one thing is certain: market crashes are inevitable, and preparation is key. Stay vigilant, stay informed, and don't let history catch you off guard.
Remember to like and subscribe for more video content. Sapiens quae vigilat.